Hi everyone, today we'll be going over accounts October-November 2021, paper 3-3, question number 4. This is structured paper 3, which consists 6 questions, each of 25 marks, and we have a time limit of 3 hours. So we will be attempting to solve each question under 30 minutes. And question number 4 relates to section A, which is of financial accounting. Without any further delay, let's get started. SWPLC has a financial year end of 31st December. It provided the following information. So the first one is that all non-current assets are depreciated using the straight line method, which means that under this method, we apply the rate of depreciation to the original cost, and depreciation is provided monthly. The per annum rates used are as follows: for buildings, that 2%, for fixtures and fittings, that is 10%, and for vehicles, that is 20%. Then, the balances on the company's books of account at 1st January 2020 included the following. Only one vehicle was owned on that date. So we have premises with the cost of 100,000 and accumulated depreciation of 5,000. We have fixtures and fittings with the cost of 64,000 and accumulated depreciation of 19,200. Then we have the vehicle with the cost of 28,000 and the accumulated depreciation of 16,800. And what we know is that there is only one vehicle. Alright, then on 1st April 2020, the company purchased a sole trader's business for a consideration of 146,000. So this is the purchase consideration. Then the assets taken over were valued at premises 94,000, inventory 21,000, and trade receivables 14,000. Okay, and all liabilities were settled by the sole trader, which means that the company only purchased the assets, which were premises, inventory, and trade receivables. Then a thing to remember here is that the difference between the consideration and the value of the assets is actually the goodwill. So let's just figure out the goodwill as well. So the goodwill is the difference between consideration. So that's 146,000 and the assets taken over, which was premises with the value of 94,000 minus inventory with the value of 21,000 minus trade receivables with the value of 14,000. So this gives us the value of the goodwill to be 17,000. Alright, then on 30 June 2020, the vehicle was sold for 9,100. So one vehicle that we owed was sold for this amount, and the next day a replacement vehicle was purchased for 26,000. Alright, then on 30 September 2020, the premises owned by the company at the start of the year were revalued at 180,000, and the company reviewed its estimate of the remaining economic life of the premises and decided to continue to provide depreciation on buildings at 2%. And the values of all premises are 50% land and 50% buildings. So in order to charge the depreciation in buildings, we actually need to figure out the 50% of premises and then charge the depreciation at the rate of 2%. Then on 1st January 2021, a review showed that the recoverable amount, which means the value that will actually be received of the vehicle, was 22,000. Let's move to the first question. We need to state how a recoverable amount is determined. So recoverable amount is basically the higher of the fair value and the value in use. Let's write it down. Recoverable amount is the higher of the fair value and the value in use. Now for the second part, we need to calculate the impairment loss. So impairment loss is just the difference between the net book value and the recoverable amount. And we're talking about the recoverable amount of the vehicle. So we just need to figure out the net book value of the vehicle on 1st January 2021. In order to do so, we know that the vehicle amounting to 28,000 was actually sold during the year. So we will actually have to look at the value of the vehicle, which was purchased on 30 June 2020 at the value of 26,000. And we know that the depreciation is being charged monthly. So if this was bought, it was actually bought the next day. So this vehicle with the cost of 26,000 was bought at the date of 1st July 2020. So let's count the month that this vehicle was used. So that's July, August, September, October, November, and December, which means that we need to charge the depreciation for these 6 months in order to figure out our net book value of the vehicle with the purchase cost of 26,000. let's have a look at the depreciation rate for vehicles. That's 20%. Okay, let's figure out the net book value. So we know that the cost of the vehicle is 26,000. Then the depreciation charge for the year is just going to be 20% of the cost, because we are providing depreciation using the straight line method. So that's 26,000 times 20%. But we also know that the depreciation is being charged monthly, and we only use this particular vehicle for the 6 months. So we just need the depreciation for the 6 months. In order to do so, we multiply it with 6 and divide by 12, which gives the depreciation charge for the year to be 2600. Now we can easily figure out the net book value, and the net book value is actually the carrying amount. Net book value is just the difference between cost and depreciation, so that's going to be 26,000 minus 2600. So this gives our carrying amount to be 23,400. Now we need to figure out the impairment loss. As I said before, impairment loss is just the difference between the carrying amount and the recoverable amount. So that's carrying amount minus recoverable amount. And impairment loss arises only when the carrying amount is greater than the recoverable amount. Alright, so we figured out our carrying amount to be 23,400. We're given the recoverable amount in our question above, and it amounted to 22,000. Let's substitute this amount. So that's 22,000. This gives our impairment loss to be 23,400 minus 22,000, which is 1,400. This concludes our second part. We can now move to the third one. Explain whether the impairment loss was an adjusting or a non-adjusting event in relation to the statement of financial position at 31st December 2020. We figured out our recoverable amount on the date of 1st January 2021, right? And we also figured out that there was an impairment loss, which means that this impairment loss should have been adjusted in the statement of financial position at 31st December 2020. Hence, we can write it down as the impairment loss was an adjusting event, as the review gave evidence about a condition which existed at the year end. Let's write it down. The impairment loss was an adjusting event because clearly the value of the vehicle would have been overstated if we did not adjust this recoverable amount. As the review gave evidence about a condition which existed at the year end. This concludes the third part. Now we can move to the fourth one. We need to prepare an extract from the statement of financial position at 31st December 2020 in order to show the non-current assets section. Alright, we're preparing the statement of financial position for SWPLC. That's statement of financial position, and this is at the date of 31st December 2020. So at 31st December 2020. Okay, and we are only preparing the non-current assets section. We can actually categorize our non-current assets into two types. The first one is intangible assets. And we are only recording intangible assets because we already figured out that there was a goodwill while purchasing the assets from another company, right? So under the intangible assets, there will be the goodwill. And we have already figured out the goodwill value in the above question. Let's have a look. So while purchasing a sole trader's business, SWPLC paid a consideration of 146,000, which resulted in a goodwill of 17,000. So we actually need to record it in our statement of financial position. Let's do that. So the goodwill is of 17,000. Then we can categorize the remaining assets to tangible section. And we can record all our premises, buildings, vehicles, and machinery under the same heading of property, plant, and equipment. Property, plant, and equipment. And this will give us our total of the non-current assets. Now we just need to figure out the net book value of all of those above mentioned assets. Let's figure that out in this section. Let's have a look at the above question again. So we know that we had premises, right? But we also know that the premises were revalued on 30 September 2020 to the value of 180,000. So we can see that there has been a revaluation upward since previously the cost was 100,000 and it is being revalued at 180,000. And whenever we're talking about a revalued amount, this amount actually relates to the cost. So this is the new cost of the premises, and since the cost is increasing, we can figure out that the months prior to September did not account for any depreciation. So we only need to charge depreciation after 30 December 2020. Let's count the months. After September, there's going to be October, November, and December. So we will be charging depreciation for these 3 months with the value of 180,000. And we know that premises consist of 50% land and 50% building, and we only charge depreciation to this building, which will be the 50% of 180,000 at the rate of 2%. So let's do this for our already existing premises. So we can just write it down as existing premises. So the cost is at 180,000. Now we just need to subtract the depreciation. So depreciation is only being charged to 50% of this premises because only 50% is the value for the building. And the depreciation is being charged at 2%. So we can write it down as 0.02. And we also know that the depreciation is being only charged for 3 months. So we can multiply it with 3 by 12. So this will give our net book value. So that's 180,000 minus 180,000 into 0.50 into 0.02 into 3 by 12, which gives the net book value of the existing premises to be 179,550. All right, let's have a look at the above question again. And we will be calculating the net book value of the new premises. So new premises were the assets taken over from a sole trader's business, which had the cost of 94,000. Which related to premises. And this asset was actually bought on 1st April 2020. So let's count the month in which this premises was used by SWPLC. So that's April, May, June, July, August, September, October, November, and December. So this is a total of 9 months. So we need to charge depreciation to 9 months for this premises, but we remember that we only charge depreciation to the 50% of the premises which relates to buildings at the rate of 2%. Let's do that. So we can write it down as new premises, which had the cost of 94,000. Now we just need to subtract the depreciation charge. So that's 94,000 times 0.50, which brings us the value for the buildings. Then we charge the depreciation at the rate of 2%. And then we remember that we only used this premises for 9 months. So we need to multiply it with 9 divided by 12. So the net book value for the new premises is going to be 94,000 minus 94,000 times 0.50 times 0.02 times 9 by 12, which gives the net book value of the new premises to be 93,295. All right. So one thing might be confusing to you guys because we did not actually subtract the existing provision for depreciation, but we only subtracted this current year's depreciation. So why so? Because for the existing premises, we actually revalued, right? So after revaluing, we actually received our new cost for this particular year. Due to that reason, we do not need to allocate any provision for depreciation of previous years in order to figure out our net book value. And in case of new premises, this is the cost, right? And new premises was bought in this current year, which means that there was no existing provision for depreciation. That's why we only subtracted the depreciation charge for this current year. Now let's have a look at another asset. So next one we have is of fixtures and fittings. And we can see that no new fixtures and fittings were added and no existing fixtures and fittings were sold. So we can just figure out our depreciation charge for this current year by multiplying this cost of the fixtures and fittings with our rate of 10%. And we're doing so because we are calculating depreciation under the straight line method. But in this particular case, we also need to subtract our accumulated depreciation. So in order to record the net book value, we will be subtracting the accumulated depreciation from the cost, and then we will also be subtracting this current year's depreciation. Let's do that. So this is fixtures and fittings. The cost is of 64,000. We had the accumulated depreciation of 19,200. Now we need to figure out our depreciation charge for the year, which is just cost times our rate of 10%, which we can write it down as 0.10. And we use the fixtures and fittings for all 12 months of this particular year, so we do not need to adjust any months. Now, the net book value for fixtures and fittings is just going to be 64,000 minus 19,200 minus 64,000 times 0.10, which gives the final value of 38,400. Let's have a look at the above information again. Now for vehicle. This vehicle is already sold, so we do not need to record this vehicle's net book value in our statement of financial position, but what we know is that we bought in another replacement vehicle at the cost of 26,000, and we also figured out that there was an impairment loss, and whenever in case of impairment loss, we always record the value or the net book value of the vehicle at the rate of the recoverable amount, which is given right here to be 22,000. So this is actually the value of the vehicle that needs to be recorded in our statement of financial position. Let's do that. So that's the vehicle with the amount of 22,000. Now we can easily figure out the total for property, plant, and equipment by adding these four amounts. So that's 179,550 plus 93,295 plus 38,400 plus 22,000, which gives the total to be 333,245. So we just need to substitute this value into our extract from the statement of financial position. So we figured the amount to be 333,245. Now, in order to figure out the total for the non-current assets, we just add the value of tangible assets and intangible assets. That's 17,000 plus 333,245, which gives the total to be 350,245. This concludes the fourth part of this question. Now we can move to the fifth one. We need to calculate the amount of evaluation reserve created during the year ended 31st December 2020. Let's have a look at the above question. So we know that the only asset we revalued was of premises, and this was revalued on the date of 30 September 2020. Alright, so in order to figure out the revaluation amount, we just need to figure out the difference between the new revalued amount and the existing net book value at this particular date. So in order to figure out the net book value at 30 September 2020, we actually need to charge depreciation till those months. So that's just January, February, March, April, May, June, July, August, and September. So we just need to charge depreciation for these 9 months in order to figure out our net book value on 30 September 2020. Let's do that. So net book value at 30 Sept 2020, that's just going to be our cost, 100,000, minus accumulated depreciation, minus the depreciation charge for these 9 months. So that's 100,000 times 0.50, because we only charge the depreciation to the buildings which consist of 50% of premises, and our depreciation rate was 2%, so that's 0.02, and we know that we are only charging depreciation for 9 months, so that's times 9 by 12. Now this gives our net book value at 30 September 2020 to be 100,000 minus 5,000 minus 100,000 times 0.50 times 0.02 times 9 by 12, which is 94,250. Now, as I said before, the revaluation reserve is just going to be the difference between the new revalued amount, which was 180,000, given right here, and then the net book value at that particular date, which was 94,250. Let's figure out our revaluation reserve now. So that's just going to be revaluation reserve equals to the revalued amount minus the net book value at 30 Sept 2020, because that is the date in which we revalued our premises. So the revalued amount was 180,000 and the net book value, we figured it out to be 94,250. So the revaluation reserve is just going to be 180,000 minus 94,250, which is 85,750. This concludes our fifth part. Now we can move to the sixth one. We need to explain how the creation of the revaluation reserve affects the director's ability to pay dividends. So the thing that we need to realize here is that revaluation reserve is not a revenue reserve. It is in fact a capital reserve, due to which this amount cannot be used in order to pay dividends to our shareholders, since capital reserves are non-distributable. Let's write it down. It has no effect as the revaluation reserve is a capital reserve which is non-distributable. This concludes the sixth part. Now we can move to the seventh one. SWPLC is involved in substantial research and development. One of the directors has suggested that the development cost should in future be capitalized. Alright, whenever we're talking about any cost to be capitalized, it actually relates to IAS 38, which is of intangible assets, right? Now, we need to advise the directors whether or not the development cost should be capitalized, and we also need to justify our answer. As I said before, this always relates to IAS 38, which is intangible assets, and it states that the development cost should only be capitalized if the directors can demonstrate that the result of the development is an asset which can be sold. Let's write it down. So IAS 38, which is of intangible assets, states that development costs should only be capitalized if the directors can demonstrate that the result of the development is an asset that can be sold. Now, what we also know is that capitalizing the development cost would definitely increase the profit as it reduces our expenses, right? So capitalizing the development costs would be profitable. Now we need to state our decision clearly. Since SWPLC is involved in research and development, personally, I would suggest the directors to capitalize the development costs. So let's write it down. The decision is that the directors should capitalize the development costs. Alright, this concludes our seventh part of this question as well as this question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.